We live in a world where debt feels invisible. Tap a button, split the cost, no interest, and no guilt. At least not today. It's not payday, but it doesn't matter. You can buy the shoes, the coffee, the concert tickets, and deal with the bill later. This is the new American credit habit. Faster, friendlier, and far more dangerous than you think. They call it convenience. 4 easy payments, no interest, instant approval. Buy now, pay later. But behind the friendly branding lies something more serious. A financial experiment changing how Americans spend, save, and think about debt. Today we're unpacking BNPL, buy now, pay later. The payment revolution that promises freedom, but quietly traps millions in a cycle of instant gratification and invisible debt. We'll look at how this system works, why it's spreading so fast, and what it exposes about a culture hooked on the illusion of affordability. At its core, BNPL is a short-term loan. You buy something, say a $200 pair of sneakers, pay 25% upfront, and split the rest into 3 bi-weekly installments. If you pay on time, there's no interest. That's the pitch, but here's where BNPL really differs from a credit card and why it's becoming a way bigger problem. Unlike credit cards, BNPL is mostly unregulated. Each purchase is its own separate loan, handled by a private fintech company rather than a traditional bank. There's no centralized record, no unified bill, and no clear way to track your total debt. Approval happens instantly. No hard credit check, even if you're already deep in debt. BNPL doesn't help you build credit. Paying on time won't help your score, but missing a payment will definitely hurt it. And late fees can reach up to 25% of the purchase price. BNPL is a financial product designed for speed, not accountability. Credit cards consolidate your spending. BNPL scatters it across multiple apps and payment schedules. That means you don't see your total balance, and that's what makes it dangerous. Where did BNPL come from, and how did it take over so quickly? The pandemic supercharged BNPL adoption. Online shopping soared, wages lagged, and inflation squeezed wallets. People needed breathing room, and BNPL stepped in to offer it. By 2023, Americans spent $16.6 billion in online purchases through these services, a 14% jump in just 1 year. Gen Z has become BNPL's biggest customer base. About 64% of Gen Z adults have used it at least once, compared to 29% of boomers. For younger people, BNPL isn't just convenience, it's survival. When rent, tuition, and groceries eat most of your paycheck, splitting payments feels like a smart financial strategy. But that's the problem. BNPL doesn't remove your financial pressures. It normalizes it. And it's easier to fall behind because there's no single bill reminding you of what you owe. For merchants, BNPL is a dream. They get paid up front, the customer feels like they're spending less, and the BNPL provider takes a 3 to 6% cut of the transaction. That's a trade-off that pays off. Offering BNPL can boost checkout conversions by 20 to 30%, and customers often spend more per order. When shoppers see pay $25 today instead of $100, it rewires the decision process entirely. It feels affordable, so they buy things they otherwise wouldn't. That's the genius and the danger. BNPL thrives on impulse. The merchant wins. The BNPL company wins. The only one losing is the customer, who ends up paying for a latte 3 weeks later. BNPL began with big-ticket items like electronics or furniture, purchases people planned for. Now it's trickled into everyday life. People are using BNPL for groceries, takeout, even coffee. DoorDash lets customers split takeout bills into installments. Think about that. Eating now, paying later. A quarter of users report using BNPL for groceries, while another 16% use it for delivery. When people start financing dinner, it's no longer a budgeting tool. It's survival mode. America has gone from financing refrigerators to financing burritos. When debt becomes a way to manage meals, BNPL stops being convenience and becomes dependency. BNPL makes spending look smaller than it really is. A $200 jacket becomes 4 $50 payments. But repeat that across 5 apps, and you've got a shadow debt that's invisible until it's too late. A Lending Tree survey found 60% of users have multiple active BNPL loans, and 1 in 4 juggle 3 or more at once. 41% of users missed at least one payment last year. Each missed payment means late fees, account freezes, or even collections. BNPL doesn't lift people up. It keeps them one paycheck behind. And unlike credit cards, which come with consumer protections, BNPL users have fewer rights when things go wrong. Try disputing a charge or requesting a refund, and you'll find out how little leverage you actually have. So why are our young people doing this to themselves? Well, economists call it the pain of paying. When you hand over cash, you feel that loss, and credit cards have dulled that pain. BNPL removes it entirely. BNPL isn't built for discipline. It's built for emotion. The apps are sleek, colorful, and rewarding. Every click feels frictionless. Every purchase gamified. It teaches people that waiting is punishment, that satisfaction should be instant. And in that world, BNPL isn't a payment plan. It's a psychological trick. So what does this say about our culture? BNPL isn't a financial tool. It's a reflection of who we've become. A country of renters, subscribers, and borrowers desperate to appear like we're thriving. We lease our cars, we rent our homes, we subscribe to everything, and now we finance our groceries. It's all built on the same illusion, that you can afford a lifestyle today and pay for it tomorrow. The American dream used to be about ownership. Today, it's about access. And the companies selling us flexibility are cashing in on that illusion. The reality is, this is a double-edged sword. BNPL isn't all bad. Used responsibly, it can be a helpful tool. If you're buying a laptop or appliance and need to stretch payments interest-free, it works. But most users aren't using BNPL strategically. They're using it to patch holes, to make ends meet when the paycheck runs out before the month does. That's why regulators are stepping in. The CFPB now classifies BNPL under credit card protections, enforcing stricter rules, clearer disclosures, and better consumer rights. But regulations can only fix so much. The deeper issue here is cultural, not financial. BNPL's rise isn't about technology. It's about mindset. We've traded financial literacy for convenience. We've replaced patience with dopamine. And we've started calling luxuries essentials. Credit cards taught Americans how to borrow. BNPL teaches them how to borrow faster, with less friction and less awareness. That's why BNPL is more pressing than traditional credit cards. It's invisible debt, scattered across apps, marketed as harmless. If you're financing coffee, you're not buying time. You are losing your freedom. Because true empowerment doesn't come from splitting payments. It comes from saving first, buying later, and owning outright. BNPL was sold as innovation, but maybe what it really represents is what happens when technology meets temptation, and culture chooses convenience over consequence. This is slide 72, and this is the real cost of buy now, pay later, not just in dollars, but in discipline. If you liked this video and found it helpful, please hit the like button and subscribe for more case analyses every month.